In early November 2022, Sam Bankman-Fried was worth roughly $26 billion on paper, running one of the largest cryptocurrency exchanges on Earth, sitting for magazine covers as the boy genius savior of an entire industry. 9 days later, his company was bankrupt. Billions of customer dollars had vanished, and he was on a plane to the United States to face charges that would eventually put him in prison for 25 years. This is how one of the fastest financial collapses in history actually happened, and how a single tweet from a rival started the countdown. To understand the collapse, you need to understand the two companies at the center of it. In 2017, Sam Bankman-Fried, an MIT graduate who'd walked away from a quant trading job at Jane Street Capital, launched Alameda Research, a crypto trading firm. 2 years later, in May 2019, he and co-founder Gary Wang launched something bigger, FTX, a cryptocurrency exchange where ordinary people could buy, sell, and trade crypto assets. On paper, these were two separate companies. In practice, the wall between them was a lot thinner than anyone outside the company understood, and that thin wall is exactly where this entire story falls apart. FTX also created its own token, called FTT, in 2019. Think of it as a kind of in-house currency that gave discounts and perks to people trading on the exchange. Here's the problem nobody saw from the outside. Alameda Research, Bankman-Fried's separate trading firm, ended up holding an enormous stockpile of FTT on its own balance sheet, and worse, was using that FTT as collateral to borrow massive amounts of real money. It's a bit like a company issuing its own gift cards, then using a warehouse full of those same gift cards as collateral to take out a bank loan. The value looks real right up until someone tries to actually cash it all in at once. On November 2nd, 2022, a news outlet called CoinDesk published a leaked internal document from Alameda Research's balance sheet. It showed that a huge portion of Alameda's assets, billions of dollars worth, was sitting in that same FTT token, an asset that Bankman-Fried's own company had created out of thin air. It wasn't illegal to report this. It was just true. And once it was public, the entire foundation of trust holding this arrangement together started to crack. 4 days later, on November 6th, the CEO of Binance, FTX's biggest rival, announced that Binance would be selling off its own significant holdings of FTT. Binance had actually been an early investor in FTX years earlier, and this announcement read like exactly what it was: a competitor pulling the pin on a grenade. FTT's price started collapsing immediately, and because Alameda had borrowed so heavily against FTT as collateral, that price crash meant Alameda's own financial position was now collapsing in real time, live, in public, for the entire crypto industry to watch. Then came the part that turned a bad week into a full-blown catastrophe. Word started spreading that FTX customers, worried their money wasn't actually safe, were rushing to withdraw their funds from the exchange. Exactly the same panic dynamic that took down the Hunt brothers and nearly took down Madoff's scheme decades apart from each other. Except FTX had a much darker problem hiding underneath. Internal testimony that later came out in court revealed that FTX had been quietly lending customer deposits, money regular users thought was just sitting safely in their accounts, to Alameda Research to help cover Alameda's own liabilities. One former executive later testified that a software function had literally been coded into the system, allowing certain accounts to go into negative balance, effectively letting Alameda draw on customer funds that weren't supposed to exist as available credit at all. By November 7th, withdrawals had essentially frozen. Bankman-Fried publicly claimed the slowdown was because of bank processing delays. It wasn't. The money to cover customer withdrawals simply wasn't fully there, because a huge chunk of it had already been funneled into Alameda to plug holes elsewhere. On November 8th, in a desperate bid to avoid total collapse, Bankman-Fried struck a tentative deal for Binance to acquire FTX outright. For about 24 hours, it looked like there might be a rescue. Then Binance looked at FTX's actual books. On November 9th, they walked away from the deal entirely, reportedly citing what they found in FTX's finances and, according to some reports, an ongoing investigation into the company. Without a buyer and without enough money to cover what customers were owed, FTX had run out of road. On November 11th, 2022, FTX and Alameda Research both filed for Chapter 11 bankruptcy. Bankman-Fried resigned as CEO that same day, replaced by John Ray III, a lawyer who had previously overseen the wind-down of Enron, brought in specifically because of his experience cleaning up corporate disasters of historic scale. The numbers that came out afterward were staggering. Bankman-Fried was eventually convicted on 7 counts of fraud and conspiracy, with prosecutors alleging he had stolen at least $10 billion from customers and investors combined, funneling money money into risky trades, lavish real estate purchases, and large political donations along the way. In November 2023, a jury found him guilty on every count. In March 2024, he was sentenced to 25 years in federal prison. What makes the FTX collapse different from something like Madoff's 20-year scheme is the speed. Madoff's fraud took 2 decades to unravel. The Hunt brothers' silver position took about 2 months to fully crash. FTX went from a $26 billion valuation to complete bankruptcy in roughly 9 days, triggered by one accurate news report and one tweet from a competitor. The entire structure had been unstable for years. It just took one honest look at the balance sheet for everyone to see it at the same time. The core lesson sits right next to the ones from every story like this one. A company built 2 organizations that were supposed to be separate, blurred the line between them until customer money and company money became functionally the same pool, and it held together only as long as nobody looked closely or tried to pull their money out all at once. The moment both of those things happened simultaneously, there was nothing left to hold it up. If you want to see this exact same pattern play out in a completely different era, go watch our Bernie Madoff video next. Same underlying lesson, decades apart, and subscribe if you want more of these financial collapse breakdowns.